We have just witnessed one of the most violent trading sessions in the history of the precious metals market. If you are looking at your screen right now, you are seeing a sea of red. You are seeing a level of volatility that makes grown men weep and algorithms malfunction. The price of silver has collapsed. We are trading at $72.75. That is down $6.50 in a single session. That is a decline of over 8%. But it is not just silver. Gold has been smashed. Gold is trading at $4,378. It is down $156. That is a 3.5% drop for the most stable asset in the world. When you see gold and silver crash together, when you see them fall in lockstep with a violence that defies logic, you are not looking at a market correction. You are looking at a liquidity crisis. This is the moment where the financial system screams for cash. It is the moment where funds, banks, and institutions stop caring about value and start caring about survival. They are not selling silver because they hate silver. They are selling silver because it is the only thing they have left that is liquid enough to pay their bills. In this emergency market analysis, we are going to dissect this crash with surgical precision. We are going to explain why a drop in gold is actually the most terrifying signal for the broader stock market. We are going to look at the mechanics of a margin cascade, how one fund blowing up triggers a chain reaction that drags down every asset class. And we are going to look at the history of liquidity crises from 2008 to 2020 to understand what happens after the crash. Does the price recover? Or is this the beginning of a deflationary winter? I'm not here to tell you to buy the dip. I'm not here to tell you to sell and run. I'm here to explain the mechanics of the machine that is currently chewing up wealth. Understanding why the price is falling is the only way to keep your head when everyone else is losing theirs. Let's look at the anatomy of the crash. To understand why silver dropped 8%, you have to look at the phrase, selling what you can, not what you want. This is the golden rule of a margin call. Imagine a massive hedge fund. Let's call them Fund X. Fund X is long stocks. They are long bonds, and they are long gold and silver. Suddenly, the bond market moves against them, or a currency trade blows up. Their broker calls them and says, "You owe us $5 billion in cash by the end of the day." Fund X looks at their portfolio. They can't sell their bonds. The bond market is illiquid and crashing. They can't sell their private equity. It takes months to sell. But they can sell gold. They can sell silver. These are the most liquid assets they own. They have a global buyer base. They trade 24 hours a day. So Fund X hits the sell button on gold and silver. They dump billions of dollars of precious metals onto the market in a single second. They don't want to sell. They love gold. They think silver is going to $100, but they have to sell to raise the cash to save the rest of their portfolio. This is what happened today. The drop in gold, $156, is the smoking gun. Retail traders do not sell gold like that. Only a distressed institution sells gold like that. Someone blew up, and the blast wave knocked over the silver market. Because silver is a smaller market than gold, when the liquidity vacuum hits, silver falls harder. Gold falls 3%, silver falls 8%. That is the beta. That is the volatility multiplier. It is painful. It is ugly. But it is not a reflection of silver's fundamentals. Samsung still needs batteries. The solar farms still need paste. The industrial demand didn't disappear in 6 hours. But the financial liquidity did. We need to talk about the dollar index. Usually, when commodities crash, the dollar spikes. In a liquidity crisis, the US dollar acts like a wrecking ball. When banks are scared, they hoard dollars. They stop lending. They sell foreign currencies. They sell assets. They buy dollars. This pushes the value of the dollar up. And since silver is priced in dollars, when the dollar goes up, silver goes down. We are likely seeing a massive spike in the DXY right now. This is the flight to safety. Ironically, in the short term, the safety is the fiat currency that caused the problem in the first place. It is a paradox, but it is how the system is wired. Investors flee to cash during the storm. They sell the lifeboat to buy a ticket on the Titanic, because the Titanic has a bar and a warm bed, for now. This dynamic creates a deflationary shock. Prices of everything fall. Stocks, crypto, oil, silver. The only thing that rises is the purchasing power of cash. This is the most dangerous environment for an investor, because if you are leveraged, if you borrowed money to buy silver, the drop in price wipes out your equity. The broker sells your position at the bottom to get their dollars back. You are left with nothing. And then, usually once the liquidity crisis passes, the Fed prints money to fix it, and silver rockets to new highs. But you aren't on the rocket. You were liquidated on the launch pad. This is why I have warned you repeatedly about leverage. Today is the reason. $83 looked like a sure thing this morning. $72 looks like a disaster this evening. That is an $11 swing. No leveraged account can survive that without deep pockets. Let's look at the psychology of the trap. This morning, at $83, the market was sucking in the longs. It looked like a breakout. It looked like blue sky. Retail traders chased the price. They bought the high. They thought the gamma squeeze would take them to $100 by Friday. Then the trap sprung. The liquidity event hit. The heavy selling started. The price fell through 80, then 78, then 75. At $75, the stop losses of the people who bought the breakout were triggered. This added fuel to the fire. Selling begets selling. Now, those people are sitting on a massive loss. They are looking at $72 and asking, should I sell now to save what is left? This is capitulation. When the bulls give up hope, that is usually near the bottom. But in a liquidity crisis, the bottom can be lower than you think. The market doesn't care about fair value. It cares about cash flow. And right now, the market is demanding cash. We have to compare this to 2020, March of 2020. The pandemic crash. Silver crashed from $18 to $12 in a week. It fell 30%. Why? Not because people stopped using silver, but because the world needed dollars. Hedge funds sold silver to pay for their losses in the stock market crash. But what happened next? The Fed stepped in. They printed $3 trillion, and silver went from $12 to $30 in 5 months. It was the buying opportunity of a decade. But in the middle of the crash, it felt like the end of the world. We are in that moment again. The numbers are bigger, $72 instead of $12, but the mechanic is the same. The baby is being thrown out with the bathwater. The good assets are being sold to pay for the bad assets. So what should you do? The most responsible advice right now is caution. Do not try to catch a falling knife. When a market drops 8% in a day, it creates structural damage on the chart. Support levels are broken. Sentiment is shattered. It takes time to repair. We might see silver test $70. We might see it test $68. Volatility tends to cluster. Big moves are followed by more big moves. If you're holding physical silver, your strategy is simple. Do nothing. Do not sell into a panic. You own the metal. You don't have a margin call. The price on the screen is the paper price. It is the price of a contract being dumped by a distressed fund. It is not the price of the metal in your hand. In fact, we need to check the physical disconnect again. I suspect that even though spot is down 8%, the premiums on coins and bars did not drop 8%. Dealers are not going to lower their prices just because a hedge fund blew up. They know the physical metal is scarce. They will likely widen the spread. Spot is 72, but we are selling for 85. That is the reality check. The paper market is crashing. The physical market is freezing. This divergence is the signal that the two markets are breaking apart. You want to be on the physical side of that break. We also need to look at the mining stocks. If silver is down 8%, the miners are probably down 10 or 15%. This is ugly. It destroys confidence in the sector, but remember, the miners are still printing money at $72. Their costs are $20. Their margin is $50. The stock price collapse is an emotional reaction, not a fundamental one. Investors are selling the miners because they are selling everything. It is a risk-off day. Everything that is not a US dollar is being sold. So as we stare at this red screen, we have to ask, is the bull market over? Did we just see the top at $83? Or is this a clearing event that sets the stage for a healthier rally? History tells us that straight line moves are unsustainable. They need to be corrected. This correction was violent. It was brutal. But it reset the table. The leverage is gone. The euphoria is gone. Now we are back to the hard work of building a trend. We are going to continue this analysis. We need to look deeper into the gold crash. Why did gold fall $150? Is it a central bank selling? Is it a sovereign wealth fund liquidating? And we need to look at the systemic risk. If a fund blew up today, what happens tomorrow? Does the exchange halt trading? Does the Fed announce an emergency liquidity facility? The crash is the headline. But the reaction of the central banks is the story. And they always react the same way. They print. Stay focused. The volatility is the test. Let's see if the support holds. We need to dig deeper into the gold crash. While silver investors are staring at a $6 drop, the global macroeconomists are staring at gold. Gold fell $156 today. That is a 3.5% move. For an asset with a market cap of $15 trillion, that is the equivalent of wiping out the entire value of Tesla in 6 hours. This tells us that the stress in the system is not local. It is global. When gold gets sold this aggressively, it means that high-quality collateral is being liquidated. In the hierarchy of money, gold is at the top. It is the asset you sell only when you have sold everything else and it wasn't enough. It is the piggy bank you smash in an emergency. So, who is smashing the piggy bank? The bond market. We are seeing signs that the U.S. Treasury market is experiencing a yield spike. When bond prices fall, the value of the collateral holding up the banking system falls. Banks use bonds to secure loans. If the bond is worth less, the bank calls the loan. The borrower has to pay cash. If they don't have cash, they sell gold. If they sell gold, the price drops. And when gold drops, the algorithms sell silver automatically because they trade in pairs. This is the contagion link. Silver is being dragged down by a crisis that has nothing to do with silver. It has nothing to do with solar panels or Samsung batteries. It has to do with the solvency of leverage in the bond market. This is frustrating for the silver investor. You did the research. You got the supply and demand right. But you are losing money because a bond trader in London made a bad bet. But here's the silver lining. Liquidity crises are usually short-lived. Why? Because the Federal Reserve cannot allow them to continue. If the bond market crashes, the US government cannot fund itself. If the collateral chains break, the banks fail. So the Fed must intervene. In 2008, they slashed rates. In 2020, they printed $3 trillion. In this crisis, they will likely open the liquidity taps again. They will inject dollars into the system to stop the bleeding. And when that fresh money hits the system, where does it go? It goes to the assets that were unfairly punished. It goes to gold. It goes to silver. So the crash is the setup for the stimulus, and the stimulus is the fuel for the next rally. We are in the pain phase of that cycle right now. The gain phase comes when the printer turns on. Let's look at the algo cascade. Modern markets are dominated by CTA funds. These are trend-following robots. For the last month, the trend was up. The robots were long. They were buying every dip. They drove the price to $83. But today, the trend broke. The drop was sharp enough to trigger a trend reversal signal in the short-term models. So the robots flipped. They went from max long to neutral, or even short in a matter of hours. They dumped billions of dollars of contracts. This is mechanical selling. It is not emotional. It is code. The robot doesn't know that silver is running out. It only knows that the price crossed a moving average. This creates a massive overshoot to the downside. The price falls further than fundamental reality would dictate. It creates a discount. If you are a human investor, this is your edge. You can see the physical shortage. The robot cannot. The robot is selling paper based on math. You're holding metal based on physics. Eventually, physics wins. But in the short term, the robot has more money. So we fall. We need to discuss the physical floor. Where does the selling stop? It stops where the physical buyers step in. We know that China was paying $80 an ounce. Now that the price is $72, the arbitrage gap is enormous. It is almost $8. This means that for every ounce of silver available in New York, there's an $8 profit to be made by shipping it to Shanghai. This gap acts like a bungee cord. The further the price falls in New York, the tighter the cord gets. Eventually, the tension snaps the price back up. Unless the price in China also crashes, the floor is solid. In fact, a price crash in the West might accelerate the drain. If silver is on sale in New York, the Chinese import data for January will be off the charts. They will use this dip to clean out the comics. We might look back at this crash as the moment the West lost its last ounce of silver. We sold it cheap to the people who need it most. And let's talk about market structure. The chart looks broken, a massive red candle consuming the previous 3 days of gains. This is technically a bearish engulfing pattern. Technical traders will look at this and say, the top is in, sell. This will invite more short selling tomorrow. The bears will feel confident. They will pile in. But be careful. In a secular bull market, bearish patterns often fail. They turn into bear traps. If the price stabilizes here, if we hold $72 for a few days, the bears who shorted the whole will get nervous. They will have to cover, and that covering will spark the next rally. We are entering a period of redistribution. The market needs to decide who owns the silver. Is it the weak hands who bought the top? No, they are gone. Is it the banks? They are trying to cover. Is it the industry? They are buying. The ownership is moving from speculators to users. Users don't sell, so the free float of the market continues to shrink. Now, let's address the dealer premiums again. I want you to verify this yourself. Go to a dealer site. Look at the price of a generic round. Spot is $72.75. The generic round is probably $82. That is a $10 premium, nearly 14% over spot. In a healthy market, premiums are low, $2 or $3. A $10 premium means the supply chain is broken. The dealers are saying, we cannot get metal at the spot price. The refiners are charging them $78, so they have to charge you $82. The spot price is a fiction created by the liquidation of paper contracts. It has detached from the cost of production and the cost of procurement. This confirms that you should not panic about the value of your stack. If you tried to sell your silver back to a dealer today, they would probably pay you over spot. They might pay you $75 or $76 because they need the inventory. So your real loss is much smaller than the chart suggests. The paper market crashed. The physical market just flinched. Let's look at the January setup in light of this crash. Does this ruin the January effect? Actually, it might supercharge it. If silver had entered January at $85, it would have looked expensive. At $72, after a correction, it looks like a Bible dip. It looks like a mean reversion entry point. Institutional money loves to buy pullbacks. They hate buying breakouts. So by crashing the price today, the algobots might have inadvertently rolled out the red carpet for the pension funds. They made the entry price attractive. This could lead to a massive volume spike on January 2nd as the smart money scoops up the discount. We also need to consider the tax implications. Today is December 29th. For taxable funds, realizing a loss today might be strategic. If they bought silver at $78 last week and they sell it today at $72, they book a tax loss to offset gains elsewhere. Then they can buy it back in 31 days or buy a proxy asset immediately. This tax loss. Harvesting adds artificial selling pressure at the end of the year. Once the calendar flips to January 1st, that pressure disappears. The sellers are gone. The buyers remain. This is another reason why the turn of the year is often a bullish pivot point. So the crash is scary, it hurts, but it is understandable. It is a liquidity event driven by external factors. It is amplified by algorithms and tax selling. It is cushioned by physical demand and arbitrage. The fundamental thesis that the world is running out of silver has not changed one bit. The Samsung battery still needs silver. The Tomahawk missile still needs silver. The debt clock is still ticking. The price action today is noise, violent, painful noise, but noise nonetheless. In the next section, we are going to look at the end game. How long does this correction last? Does it go to $65? Does it bounce tomorrow? We will look at the support levels that must hold to keep the bull market alive. And we will give you the strategy for surviving the margin call environment without getting liquidated. We are finding the floor. We need to identify the floor. When an asset falls 8% in a day, the first question everyone asks is it over or is there more pain to come? To answer that, we have to look at the chart structure. We have to look for the support zones where the buyers are likely to step back in. The most obvious level is $70. Why? Because $70 was the breakout point. It was the ceiling that held us down for weeks. In technical analysis, there's a principle called polarity. Old resistance becomes new support. The ceiling becomes the floor. If the price drops to $70, it is retesting the breakout. It is checking to see if the demand that pushed us through $70 is still there. If we bounce off $70, the bull market is perfectly intact. It was just a backtest, a violent, terrifying backtest, but a technical necessity. However, if $70 fails, the next major support is down at $65. That was the launch pad for the Christmas rally. A drop to $65 would be a 20% correction from the highs. That defines a bear market in technical terms. But in a volatile commodity like silver, 20% swings are just noise. They are the cost of doing business. So watch $70 closely. If we see high volume buying at that level tomorrow, the bottom is in. If we slice through it like butter, we have further to fall. But remember the physical floor. At some point, the arbitrage gap becomes so wide that the physical market simply swallows the paper market. We are getting close to that point. Let's talk about the miner's dilemma. If you own mining stocks, today was a bloodbath. Stocks like First Majestic, Hecla, and Pan American likely dropped 10 to 15%. Investors are looking at this and panicking. The miners are crashing. The leverage is working against me. But step back and look at the cash flow. Even at $72, these companies are wildly profitable. Their cost of production hasn't changed. It is still $20. They're making $50 an ounce profit. Does a one-day drop in the stock price change the cash accumulating in their bank accounts? No. The stock market is an emotional beast. It sells first and asks questions later. It is pricing the miners as if silver is going back to $30, but if silver stays above $70, the earnings reports in January will be monstrous. The PE ratios will collapse to single digits. This creates a value trap in reverse. The stocks become so cheap relative to their earnings that value investors have to buy them. So, if you are holding miners, you are holding a coiled spring. The disconnect between the stock price and the cash flow is at historic extremes. This tension usually resolves with a massive rally in the equities, but you have to survive the liquidity flush to see it. The weak hands are selling their stocks to cover margin calls on tech stocks. They are selling the winner to pay for the loser. Do not be the person who sells the winner. Now, let's look at the macro timeline. How long do liquidity crises last? In March 2020, the crash lasted about 2 weeks. In 2008, the acute phase was about a month. These events are sharp, but short. Why? Because the system cannot handle prolonged deflation. If asset prices stay low for too long, the debt collateral fails, and the banks go insolvent. The central banks are forced to react quickly. We are likely looking at a few days of chaos, maybe a week. This is ghost week after all. But once the calendar flips to January, and the liquidity returns, and the Fed signals support, the V-shaped recovery begins. The rebound is often just as violent as the crash. We could see silver drop to $70 on Tuesday and be back at $80 by Friday. That is the nature of a thin market. It overshoots in both directions. This brings us to psychological armor. How do you sleep tonight? You just lost a lot of paper wealth. It hurts. The best way to handle this is to zoom out. Look at where we were on December 1st. We were at $60. Today, even after the crash, we are at $72. We are still up 20% in a month. If someone told you in November that silver would be $72 by Christmas, you would have been ecstatic. You are only unhappy because you saw $83 first. This is anchoring bias. You anchored your expectations to the high. Reset your anchor. Look at the trend. The trend is up. The low of this month is higher than the low of last month. That is the definition of a bull market. Higher highs, higher lows. We just made a higher high. Now we are looking for the higher low. Let's discuss the contrarian signal. When everyone is euphoric, you should be worried. Yesterday, everyone was euphoric. Today, everyone is miserable. Sentiment is flipped from greed to fear in 24 hours. This is usually a sign that a bottom is near. Markets bottom on fear. They top on greed. The fact that people are panic selling, posting angry comments, and declaring the bull run dead, that is the fuel for the turnaround. The weak hands have vomited their positions. The market is lighter. It is cleaner. It is ready to rise again. We also need to consider the geopolitical wildcard. While the markets are crashing, the world is not getting safer. The Middle East is still a powder keg. The South China Sea is still tense. If a headline breaks tomorrow, tanker attacked or straits closed, oil spikes, gold spikes, silver spikes, the geopolitical bid is the put option under the market. It can trigger a reversal at any moment. In a liquidity crisis, people forget about geopolitics. They focus on cash. But the real world doesn't care about margin calls. The risks are still there, and silver is the hedge against those risks. So selling your hedge because the price dropped is counterintuitive. You need the hedge more when the system is unstable, not less. Let's talk about the short sellers again. Did they win? Today they won. They made a lot of money on the drop. But are they out? Probably not. Greedy shorts often double down. They see the price drop and think, it's going to $50, so they add to their positions. They use the profits from the drop to short more. This reloads the short squeeze gun. If they don't cover here, if they get greedy, and the price turns around at $70, they get trapped again. The cycle repeats. Squeeze, crash, reload, squeeze. We are just in the crash part of the cycle. The reload comes next. Finally, a word on physical possession. If you are holding physical silver, today was a non-event. Did your coins melt? Did they get smaller? No, you still have the same number of ounces. The only thing that changed is the number of fiat currency units a panicked banker is willing to offer you. Why would you let a panicked banker determine the value of your wealth? He is selling because he has to. You don't have to do anything. You have the luxury of time. He has a margin call due at 8 a.m. He is the distressed seller. You are the strong holder. The debt hasn't gone away. The shortage hasn't gone away. The crash is an opportunity, not a funeral. Stay tuned. The recovery plan is coming up. We have arrived at the final chapter of this emergency broadcast. We have dissected the anatomy of the crash. We have looked at the contagion from the gold and bond markets. We have analyzed the failure of the leveraged longs and the aggression of the algorithmic shorts. Now we must look forward. The damage is done. The chart is ugly. The account balances are lower. But the market does not care about your feelings. It cares about liquidity, and history teaches us one undeniable lesson about liquidity crises. They end, and when they end, the asset that was sold the hardest bounces the highest. In this final breakdown, part 4, I'm going to give you the recovery plan. I'm going to show you exactly what to look for in the next 48 hours to confirm the bottom is in. I'm going to explain why this crash might actually be the rocket fuel for the January effect. And I am going to leave you with the final verdict on the state of the silver squeeze. The battle was lost today. But the war is far from over. Let's finish this. Let's look at the history of flash crashes in bull markets. In 2011, silver dropped $6 in a day. 2 weeks later, it was making new highs. In 2020, it dropped 30%. 5 months later, it had doubled. Why does this happen? Because a liquidity crash is artificial. It removes the paper pricing. It clears the order book, but it does not change the structural demand. Samsung did not stop building batteries today just because a hedge fund blew up. The U.S. Mint did not stop needing planchets. The Chinese government did not stop hoarding strategic reserves. The physical demand is a constant force. The paper price is a variable force. When the paper price drops too far below the physical reality, it snaps back like a rubber band. This is the V-shaped recovery. It happens because the value investors, the people with deep pockets, step in. They see $72 as a gift. They see it as a chance to buy the asset they missed at $60. So do not be surprised if we see a violent rally tomorrow or Wednesday. The shorts who pressed their bets today will try to cover. The value buyers will step in. The volatility works both ways. If we can fall 8% in a day, we can rise 8% in a day. Do not bet against the snapback. I want you to think about the pension fund manager we discussed earlier. He has billions of dollars to deploy on January 2nd. Yesterday, he was looking at silver at $83. He was hesitant. It looked expensive. It looked parabolic. Today, he is looking at silver at $72. It looks cheap. It looks like a pullback within an uptrend. This crash has effectively de-risked the entry for institutional capital. It washed out the froth. It reset the indicators. It gave the big money a safe entry point. So the probability of a massive January inflow has actually increased. The funds can now buy size without chasing the all-time high. This sets up a slingshot for the first week of the year. We might spend the next few days chopping around $72, building a base, and then, when the calendar flips, the volume explodes. The January effect is not canceled. It is just getting a better price. So what are the signals? What do you need to watch tomorrow morning? Signal 1, the $70 support. We must hold $70. If we break below $70, we could see a flush to 65. But if we bounce off 70, or if we hold 72, that is strength. That is the market saying, we accept this price. Signal 2, the gold recovery. Watch gold. If gold reclaims $4,400 or $4,500, it gives silver permission to fly. Gold is the leader, silver is the follower. Watch for stability in the yellow metal. Signal 3, the dollar index. If the dollar starts to fade, if the panic bid for cash subsides, commodities will rise. We need the fear trade in the dollar to cool off so the inflation trade in silver can resume. Signal 4, the physical premiums. Keep checking the dealers. If premiums stay high, the bottom is near. If premiums collapse, then maybe the demand is gone. But I doubt premiums will collapse. The shortage is too real. I want to leave you with a thought on survival. Investing in silver is not easy. It is the most volatile, manipulated, frustrating market on earth. It shakes you out. It scares you. It creates euphoria and then crushes it. That is the nature of the beast. But the reward for surviving this volatility is generational wealth. The people who sold Amazon in the dot-com crash because it dropped 90%, they missed the 1,000-fold return. The people who sold Bitcoin in every crash, they missed the million-fold return. You have to be willing to look like an idiot in the short term to look like a genius in the long term. Today, you might feel like an idiot for not selling at $83. Forgive yourself. Nobody catches the exact top. The goal is not to trade perfectly. The goal is to be right about the big picture. And the big picture is clear. The fiat system is dying. The debt is exploding. The physical world is running out of resources. Nothing that happened today changed those facts. So here's the verdict on the liquidity crash. It was painful, it was ugly, but it was necessary. It cleared the leverage, it reset the sentiment, it opened the door for institutional money. $72 is still an incredibly high price compared to where we started. We are still in a massive uptrend on the weekly and monthly charts. Do not let one red day erase the progress of the last 3 months. Hold your physical metal. Ignore the paper noise. Wait for the liquidity to return. The banks fired a shot across the bow, but the ship is still sailing. And the destination remains $100. Subscribe.